Good morning, and welcome to today's webcast entitled World Silver Survey 2021 presented by the Silver Institute. Your program will begin shortly. To view the presentation in full screen mode, click the F11 button on your keyboard. In the lower right corner of your screen, you will find the Action Center. If you have any questions for the presenter during the webinar, they can be submitted by using the Questions and Answers tab. If you experience technical difficulties, contact support by clicking on the Technical Support tab in the Action Center or call 1-877-992-7225. Again, that phone number is 1-877-992-7225. If you are disconnected from the webinar, you can re-enter the program using the meeting URL provided to you and the email you used to register. At this time, I would like to introduce our moderator for today's program. Today's moderator is Michael DiRienzo. He is currently the Executive Director at the Silver Institute. Good morning, Michael. The floor is yours.
Thank you, Tyler. Good day. Hello, everyone. I'm Michael DiRienzo, the Executive Director of the Silver Institute, and it is my pleasure to welcome you to this webcast featuring the highlights from the 31st edition of World Silver Survey. We appreciate you being with us today. The Silver Institute's annual World Silver Survey is considered the authoritative report on the global silver market. It is read by the breadth of the silver industry, and it is widely referenced and is the most quoted report on the silver market. During today's webcast, which will run 1 hour, you will hear from members of the team that researched and authored this year's report. Philip Newman, Metals Focus's Managing Director, and his colleague, Adam Webb, Director of Mine Supply, will discuss the key findings from World Silver Survey 2021. They will cover supply, demand, and investment, and they will also discuss the outlook for 2021. This year's edition of the survey was independently researched and compiled by Metals Focus, which has a team of 30 professionals and consultants with 8 offices worldwide. Now, this research was made possible by the financial support of our member companies and other contributors to the World Silver Survey. We are grateful to these firms, which include mining companies, banks, dealers, depositories, and refiners from a range of countries in North and South America, Europe, and Asia. Please note that you can download a copy of World Silver Survey 2021 free of charge from our website at silverinstitute.org. Philip and Adam will take questions at the conclusion of their presentation. If you'd like to submit a question, you will find the question mark icon at the bottom of the screen. Simply click that icon and type your question at any time during the presentation. I will then ask Philip or Adam that question on your behalf, and we hope to get to all these questions, time permitting. At this point, I will turn the platform over to Philip and Adam for their presentation. Gentlemen, welcome. We look forward to your remarks.
Excellent. Thank you very much, Mike, and good day, everyone. As Mike has said, myself and Adam will look at the silver market both for last year and also look at our outlook for 2021 as well. Before doing so, as Mike mentioned, I'd like to add our thanks for Metals Focus to the major sponsors on this slide. And then on this slide, the sponsors and contributors who supported the Silver Institute has made the World Silver Survey possible. So let's crack on now with an overview of the market before I hand over to Adam. So a slide that will be familiar to many of you, and just to really pick out a couple of the key takeaways in terms of the spot gold and silver prices you see here for the past 16 months or so. Of course, if we think back to Q1, which I suppose is like I guess another world at the moment, when we had the correction, the sharp correction in equities, of course, as really, I guess, as the realization of the pandemic really came to fruition, That, of course, saw a whole range of commodities sold off, including gold and silver. And one of the challenges that silver faces is that it, as well as outperforming to the upside relative to gold, it can also underperform to the downside. And we certainly saw that in Q1. You'll see that also in a slide in a moment when I look at the gold-silver ratio. But of course, when we saw that, that was also reflecting the concerns about the outlook for the global economy. We saw base metals being sold off. So in a sense, silver really faced being sold off as a precious metal and also as an industrial metal as well. And that proved to be short-lived, as many investors, rightly so I would suggest, viewed silver as being oversold, and therefore we saw gold and silver performing exceptionally well, the safe haven bid driving both up, gold to a record high, silver almost getting up to $30 in August. And I would suggest one reason why we perhaps didn't see further upside from silver is the headwind it faced in terms of, as I said, the ongoing concern about the global economy and what the outlook held. Of course, when you look further beyond that, on the right-hand side, silver has performed very well, outperforming gold, briefly getting over $30 in Q1 when we had that social media frenzy that will come to in a little while. So I said a lot about the gold-silver ratio. Of course, in Q1 last year, getting up to a record high briefly of 127. Since then, overall, trending lower. And at the present time, we are in the high 60s. But what does that mean from a long-term point of view? So the slide here, looking at the ratio over the past 30 years or so. And so you can see really that the extent to which the ratio has now got down to that long-term average. But from our point of view, we do think that there is further to go in terms of the ratio between the two falling. In other words, we do expect that silver over much of this year will continue to outperform gold. Of course, when we think about the strength of silver most of last year and into early 21, key to that, of course, has been the investment backdrop. And there's a couple of slides we have here, one or two further on after Adam has spoken as well. First of these, one you've seen many times from Metals Focus, looking at the net managed money longs positions as reported by the CFTC. And of course, for 2019 and early 20, they really got up to some pretty robust levels. Of course, when we had the exchange for physical crisis, for want of a better word, in March, carrying on over to the summer, and we had those forced closure of positions, that explains that sharp drop that you see there. But of course, since then, positioning has been rebuilt to quite a noteworthy level. But this is only one indicator. I think something else that we've seen that we talk about in the silver survey has been the growth in the OTC, the over-the-counter market, especially in Western markets. And of course, if you get a chance to look for the silver survey, something which stands out in the investment chapter is the growth in trading, futures trading in China, on the SGE and the SHFE as well, and how robust that was. The other area, of course, aside from coin and bar that we'll cover a bit later, has been the incredibly strong performance in the exchange-traded product market. We've seen that hit record highs, and even though we saw some modest liquidations earlier this year, that doesn't really detract from the performance we saw in 2020, when we had over 330 million ounces of net additions for the full year, and the fact that we've seen further additions this year as well. Importantly, of course, we've seen record high in value terms as well. So with that, after that sort of potted history, I'm going to hand over to Adam now, who will take you through the supply for 2020 and 2021. So Adam, the floor is yours.
Thanks very much, Philip. So now I'll walk everyone through the mined silver supply for 2020 and 2021. So first of all, global mined silver output fell by 5.9% year on year to 784.4 million ounces last year. And that's a drop of 48.8 million ounces year on year. And this was a direct result of the COVID-19 pandemic, which led to temporary mine closures in several major silver producing countries. And the map you can see here highlights which countries had the biggest decreases and increases in silver output year on year in 2020. So Peruvian silver production declined by the most, by 26.1 million ounces, followed by Argentina, 10.0 million ounces, and Mexico, 9.6 million ounces. And these declines were all largely driven by a result of the COVID-related mine closures. And several other countries were impacted by this as well, such as Bolivia, China, and South Africa. In Canada, output was impacted by COVID-19 disruption. However, actually the closure of Silvertip in February 2020 due to market conditions actually had a greater effect. So despite this COVID disruption, output did rise in several countries, and most notably in Chile, where silver production rose by 9.1 million ounces. And this was a result of higher byproduct silver output from copper mines. So despite widespread suspensions in neighbouring countries, mining operations in Chile were actually able to continue operating at near full capacity whilst they implemented strict health and safety protocols. And elsewhere, output was up by 1.2 million ounces in both India and Australia. And this was driven by higher grades at Hindustan Zinc's Sindhstar Kurd mine in India, and higher grades at Rosebery in Australia, combined with increased throughput at Century Tailings. In Indonesia, output was up due to the ramp up of underground operations at Grasberg, which resulted in the mine's silver output increasing by 1.2 million ounces year on year. So this 5.9% drop in mined silver production was actually the biggest on record, with our data going back to 2010. And this resulted in global mined silver production reaching its lowest levels since 2011. And that continues a declining trend since output reached 899 million ounces in 2016. Now, the two dominant producing regions remain Central and South America and North America. However, both are now almost equal, with Central and South America producing just 1 million ounce more than North America in 2020. And both regions have similar growth prospects for this year, so that situation is likely to remain the same in 2021. Now, on a country level, Mexico remains a dominant producing country. It was responsible for 178 million ounces of silver output, or 23% of global supply last year. Peru remains the second biggest producer, despite that significant decline I mentioned earlier, but it was only 1 million ounce above output from China. Now, Chinese output was impacted by COVID closures in the early part of the year, however, less severely so than Peruvian production. And that takes me on to my next slide, just to have a closer look at the disruption caused by COVID-19 to silver mining last year. Now, that disruption mainly occurred in the first half of the year, and this is really demonstrated in this chart, which shows monthly silver production from several countries. Mexico, Peru, and Bolivia were all heavily impacted, and you can see the biggest declines here came in April and May. Chinese output was the first to be impacted in February, with some mines forced to temporarily halt operations before mines in the country returned to more or less normal production rates in March. The World Health Organization declared the global pandemic on March the 12th, and then shortly after this, countries including Mexico, Peru and Bolivia enacted lockdown policies that required mines to temporarily halt. Now, exemptions were granted to some operations, and this did allow production to continue to some extent, but at extremely reduced capacity. Meanwhile, mines in other countries such as Chile, the US, Australia and Russia were able to continue as normal whilst implementing new health and safety procedures to protect their workers. Now, the final restrictions on mining to be lifted were in Mexico on May the 30th. However, it took time for many mines to return to full production rates as they had to implement new procedures and protocols to safeguard workers. And there were also localized outbreaks at individual mine sites, which required these individual mine sites to subsequently halt operations. Now, by the end of the year, miners had successfully implemented these strategies to mitigate the risks and were mostly operating at full capacity. So overall, we estimate the COVID-19 pandemic led to a 54 million ounce drop in output. And this is greater than the year-on-year decline, which I mentioned earlier, as we had expected some growth in mine silver production at the start of 2020. So the majority of silver, 73% in 2020, is produced as a byproduct of mining other metals. So namely lead, zinc, copper and gold. Lead and zinc are commonly mined together for geological reasons, and these mines are still the biggest source of silver, accounting for 32% of output last year. Production from primary silver mines was actually disproportionately affected by the COVID-19 pandemic due to the concentration of these mines in countries where mining was most heavily impacted, so particularly Mexico and Peru. And this resulted in a 12% drop in silver output from this source, compared to a 7% drop from lead zinc mines and a 6% drop from gold mines. Silver output from copper mines actually increased by 3% year on year, and that was due to the higher output from Chile, which I mentioned earlier. And you can see in the chart on the right here what was driving the changes in byproduct silver production. So zinc, lead and gold output all fell year on year, again driven by the COVID-19 pandemic. Meanwhile, copper output remains almost flat, as higher output from existing mines, particularly Grasberg, and the ramp up of some new projects offset losses from COVID-19 disruption, particularly in Peru, the second biggest copper producer. So now moving on to look at the cost of production for primary silver mines in 2020. So the disruption caused by the pandemic did put upward pressure on costs in 2020 due to higher unit costs during ramp up and ramp down phases between closure periods. And there were also additional pandemic related costs for new procedures such as quarantine, supplementary PPE and testing of workforces. However, these factors were actually offset by a weakening of local producer currencies to the US dollar, lower oil prices, which eventually feed through to diesel costs, and most importantly, higher byproduct credits. And as can be seen from the chart on the left here, which shows byproduct credit contributions from each metal in the bottom half and overall all-in sustaining costs in the top half, we can see from this chart that in the light blue there, the main driver for higher credits was from gold. And this was a result of the 27% year-on-year increase in the gold price. Now, there was basically no increase in contribution from zinc and lead, as prices of these metals actually declined year on year by 10.9% and 8.6% respectively. And also revenues from both of these metals were further negatively impacted by increased treatment charges for both. So this 3.7% drop in all-in sustaining costs, combined with a 27% year-on-year rise in the silver price, means that the vast majority of primary silver mines were profitable last year. And you can see this from the cost curve on the right. Last year's average silver price of $20.55 per ounce intersects the all-in sustaining cost curve from last year at the 94th percentile. So the chart on the left here shows the change in reserves for primary silver mines between 2019 and 2020. So silver contained in reserves for primary silver mines and projects increased by 6.9% year on year to 3.6 billion ounces. And this was driven by new additional reserve estimates, such as at Polymetal's Prognos project, alongside resource conversion at existing mines, and the addition of reserves from Cerro Los Gatos following the public listing of Gatos Silver. So these factors significantly outweighed depletion from mining and led to growth in reserves. The chart on the right shows the value of M&A activity in the silver sector, which remains subdued and was flat year on year at $38 million. And again, the COVID pandemic was the main driver of this, as this resulted in a lot of market uncertainty. And generally speaking, companies were more focused on managing the impact of the pandemic rather than on growth through acquisition. Now, in the second half of the year, activity did increase, but it was mainly centered on the lower value junior exploration end of the market. The most significant corporate activity for silver, which I alluded to a minute ago, was the IPO of Gatos Silver in November 2020, which began trading on the New York Stock Exchange and the TSX. And the company's Gatos Silver mine, which commenced production in September 2019, is expected to produce 7.8 million ounces this year. And that would make it one of the top 20 silver mines in the world. Now, just briefly here, I want to touch on hedging and streaming. So silver producers' hedge books increased by 26.9% year on year. And this is the position as of the end of the year. Options continue to make up the majority of the combined hedge book for the second year running, accounting for 86% of the total. In the first half of the year, hedging activity was relatively subdued, but this changed substantially in the second half of the year as spot silver prices rose and producers were able to secure higher prices for forwards and options. Meanwhile, silver production covered by streaming and royalty deals increased marginally, rising by 1% or 0.3 million ounces. And this small rise, however, did contrast with the decline in global mined silver supply. And this was a result of higher output from Penasquito, which Royal Gold holds a royalty on and Wheaton Precious Metals holds a stream on. And this meant the amount of global supply covered by streaming and royalties actually increased a small amount to 4.6% in 2020. So for my final slide, before I hand back to Philip, I'm just going to have a look at our expectations for 2021 for mined silver supply. So what we're expecting is a strong rebound in output this year, following the significant disruption caused by COVID-19 in 2020. So we anticipate there will be minimal disruption to output from the ongoing pandemic, as miners have now successfully implemented new procedures and protocols to protect workers. And the majority of mines were operating at full capacity by the end of 2020. And this, combined with the global vaccine rollout, should allow most mines to operate at full capacity throughout the year. And as a result, we're expecting the biggest growth from regions that were most heavily impacted by the pandemic, with a 26.5 million ounce increase and a 26.2 million ounce increase anticipated for Central and South America and North America respectively. And the increase in North America will additionally benefit from several new projects which are ramping up in Mexico, such as Cerro Los Gatos, Juanicipio and Capella. And this will drive mine silver output up by 8.2% year on year to 848.5 million ounces. And with that, I will hand back over to Philip.
Excellent. Thank you very much, Adam. So what I want to do first is to dial back to 2020, following Adam's comments on 21. And just to give you very quickly the 30,000 foot view of the changes for global supply, 19 versus 20. I won't go through all of these in detail, but please, as Mike said, feel free to ask a question, or if you run out of time, please do email myself or Adam as well. So we are ultimately looking for a 4% drop in global supply for last year. And that, in terms of our series, is the first time it's fallen below 1 billion ounces. So let's now move on to the demand side. And obviously starting, first of all, with industrial offtake. This saw a 5% drop last year. That was, I think, actually quite modest because we didn't see declines across the board, either sectorally or in terms of some of the key countries as well. So electrical electronics was down about 4%. But interestingly, within this, as I'll show you in a moment, the solar market, the PV, was actually up 2%. But staying with this slide, I think one of the key areas which dragged down the total for E&E was a weaker auto market. We saw also a double-digit loss in brazing, down about 11%. As you can imagine, given the restrictions, we had declines in housing, declines in construction. The other element, other industrial, that was actually down quite heavily. That was down about 7%. And one of the key elements there was the weakness that we saw in the Indian market. And India is a country that I will return to quite a few times, especially in relation to 2020. And one of the interesting things about India is that it's a top 5 industrial country, but what it certainly felt was not only the economic weakness in India before the pandemic hit, but also with record local rupee silver prices that hit some of the price-sensitive areas of other industrial demand. And some of those, for example, were silver-coated sweets and betel nuts. I've tried one of those, but not the latter. The Zari industry has continued to take a hit because of the restrictions last year. The wedding sector was certainly hit quite dramatically as well. And I think the other element, if you speak to our colleagues in Mumbai, they'll talk about the informal nature of a lot of the industrial segment in India. And that, I think, exposed it to, again, the impact of the pandemic. But as I mentioned, one of the success stories last year in the industrial area was the photovoltaic sector. And that really reflected a strong end to 2020. The first half was hit quite hard, especially in terms of panel production. We think about the impact of the pandemic in China, which of course was the first country to suffer with their nationwide lockdowns. China obviously dominates by a country mile the production of finished cells, although in terms of silver paste and silver powder, there were a few other protagonists in that market. But what was interesting was the extent to which the market really recovered as we went through the latter half of the year. And as I mentioned, that really helped it to finish with a 2% growth, getting back to levels that we saw in 2017. So I think it was an exceptionally strong performance from the PV market. And I think that's also interesting that when we think about the investment demand that we saw last year, and also I think interestingly this year, one of the attractive qualities or attractive draws for investors is thinking about the outlook for silver in green applications. But I think that's an interesting view by investors, because if you look at this chart, silver has really held that position for several years in the PV market alone. But it's certainly a factor which I think has, again, attracted investors into the marketplace. One of the things I touched on earlier was the strength of investment demand. And we looked at the CFTC, we looked at the exchange traded product market. But another exciting area, and one which has certainly been capturing the headlines during early 21, has been the coin and bar market. Now, gosh, we could probably spend an entire presentation on this one slide. Last year, we continued the recovery following the lows we saw in 2017. The strength of the US markets and other markets as well. Singapore to a far less extent, but Germany and the likes of Australia, which is captured in the orange bar. When we think about when the pandemic hit, the price correction in March, there was certainly plenty of stories about the shortage of silver. But I think what we certainly saw was a shortage of silver in the correct form, in the correct location. Again, when we think about the restrictions on flights that we saw at that time. And so I think it's probably fair to say, especially when we look at that green bar and the orange bar, if there had been more product available in the right location, that figure would have certainly been, I think, considerably higher, certainly outstripping 2016. I think the other element, just really you can see here, is the collapse in India. Now, I've mentioned earlier about the record rupee prices, and one thing we saw in the second half of last year that's carried on into early 21 have been widespread and pretty deep liquidations by investors. A knock-on effect of that has been the collapse in bullion imports into India. Now, normally on a monthly basis, you would measure imports into India in the tens of millions of ounces, normally somewhere between 10 and 12 or 13 million ounces. Whereas in the back end of last year and this year, you're measuring those figures in hundreds of thousands of ounces. Such has been the collapse. But I think it's also a testament to the strength of the market that even with that going on, you've still seen a figure getting up to those levels. And so just to really capture the weakness in India, just to show you how markets behave really quite differently, we actually saw a rise in the US. Industrial demand was strong, but this really reflects the strength of the coin market. I should say that in terms of fabrication, this doesn't include bar demand. China, that weakness in industrial demand was certainly behind that decline, especially over the first part of the year, with a relatively strong end to the year, which I think helped to minimize that year-on-year decline. Japan was really quite interesting. There were certainly market share gains in the industrial because of restrictions which hit some of its key competitors earlier in the year. And India, you can see the weakness that we saw not only in the bar market, also the coin market or industrial demand, but also in jewelry and silverware. And so that really gives us, in terms of bringing it out for a view for 2020, you can see, unfortunately, red across the board with a weakness in that jewelry, silverware, and in the industrial component. Photography was interesting. We always speak about structural losses, whereas last year, because of medical centers around the world, of course, focusing on pandemic, you saw other procedures postponed, and that, for example, hit the need for X-rays. And so bringing that all together, because you had a much deeper fall in demand versus the weakness in supply, it meant that the surplus was the highest that we saw in our series. But of course, the comments I made about ETFs, this was, absolutely instrumental in absorbing that surplus and therefore in the price strength that we saw in 2020. So where do we see the market heading this year? So following the same treatment, and we'll touch briefly on a couple of these elements. Of course, Adam has spoken about the growth in mine production, and that, of course, is absolutely pivotal behind the 8% expected rise in global silver supply this year to a 5-year high, a rise in scrap, also carrying on from the upside we saw in 2020 as well. On the demand side of the market, this is quite rare that we have every key element in green with no declines. Again, we don't want to dwell too much on the rise in photography. As I said, that does reflect the low base that we saw in 2020, but we are looking for strong gains really across these elements. What I would say is just to highlight a couple of upside and downside risks to the forecast for physical investment. Of course, that has started off so incredibly strong. Out of interest, or it's quite interesting that in the US, coin and bar demand was actually quite sluggish in January. But then when things really caught fire with the social media, that I think brought silver to into the headlights for a lot of mainstream investors. They, I would say, especially in the US or Germany, which has carried on being strong, they haven't been attracted by some of the conspiracy theories about trying to squeeze out a short position. For many investors in the US, they are concerned about some of the monetary and fiscal policies of the new US administration. And I think has been behind the strength we've seen, which is really carried on from the back end of January through to late April. The supply shortages are still there in terms of products. Premiums from wholesale and retail are still pretty eye-watering. But from our point of view, it's important trying not to just extrapolate from that strength. Demand can be quite volatile for coin and bars, there's no doubt about it. But I think one interesting element just to pick up on, again in the US, is as many of you will know, the US Mint is launching new designs of its gold and silver eagles at some point over the summer. And the summer, can be a time when demand does back off because people go on vacations, for example. But I think that will certainly attract investors. And of course, if prices are volatile at that time, I think it could be a really exciting time for coin and bar demand in the States. And it just won't be about the US Mint. I think other bullion coin providers, manufacturers of 1 ounce rounds or 5 or 10 ounce bars will also certainly benefit. So it's quite possible that when we next get together, and God willing, that will be face-to-face in November, we may be looking at a higher figure for physical investment than we're currently showing. A couple of risks to highlight on the jewelry and silverware, given how important India is to the market for both. Unfortunately, we've had new lockdown restrictions announced in the past couple of weeks. And so again, if you speak to our guys in Mumbai, I think they are certainly concerned about the outlook this year for jewelry and silverware, and also in the gold market as well, without doubt. But if you bring that all together in terms of the much stronger recovery in demand versus supply, yes, the market remains in surplus in our view for the 6th year in a row, but we believe that will be comfortably absorbed. If you've had a chance to look in the survey and Mike Dorenzo's press release, you'll see that we're forecasting a 150 million ounce rise in ETPs for 2021. That, I guess, on one sense may look modest compared to the 331 improvement for 2020, but I think, ultimately you are going to see, in our view, new highs for ETPs. Although holdings tend to remain extremely sticky, as I mentioned earlier, because you do have that bias towards retail investors, given so much of those positions will be in the money, I think, you will see some liquidations. And so I think, gross buying will certainly be higher than our forecast 150. But ultimately, taking a step back, you're going to see, in our view, new record highs, both in volume and value terms for 2021. And so given our positive view for investor demand for this year, with yields, with interest rates remaining, negative in real terms, concerns rising about inflationary expectations, we do believe that silver prices will enjoy further upside this year. This shows our quarterly our quarterly average, I should say, for 2021. We think that prices could well peak at around $32 this year, with a low perhaps of around the mid-20s or thereabouts. But ultimately, we're looking for a 1/3 increase in the price to average $27 this year. And that, of course, will be the highest since 2013. And that does already follow on a strong gain for 2020 of around 27%. So on that positive note, I would like to hand over back to Mike, please, if there are any questions, myself or Adam.
All right. Well, thank you. We do have several questions here. And let's just start off with, you mentioned some of the risks already with potential, for the demand side of the equation. Are there any other risks that you see for demand going forward for 2021, Philip?
Sure. I think there's probably a couple of others that are worth mentioning. I mean, I talked about the upside for coin and bars, and I think that's certainly where our bias would lie towards. I would say, though, that, if you speak to dealers, what they want is price volatility rather than, say, stable high or even low prices. And I think, if prices do stabilize, that could certainly detract. And, if you're against a backdrop of equities remaining strong, we're not really expecting liquidations this year. That could certainly detract from silver and gold buying as well. The other element is on the industrial side. Again, we are expecting the macro backdrop to continue to gather momentum. But again, if that is unwound, that could pose a risk as well. So I think those are some of the key other issues I would probably highlight, Mike.
Okay, thank you. This question is for Adam. Adam, do you think current silver prices could incentivize miners to begin construction of new projects?
I would say on the project side of things, to incentivize new projects, it's generally not dependent on the short-term prices. It's more dependent on the long-term price assumptions of the owners of those projects and the particular economics and circumstances of those projects. And I think, also generally, and for silver, but also across other commodities, miners are generally still focused on maximizing the value of their investments by investing in low-cost, high-margin projects, and generally remaining cautious on capital expenditure. So we're not seeing marginal projects. I wouldn't expect marginal projects to be funded in the pursuit of ever rising production. So if expectations are for higher prices by companies, then what we may see is projects which have been curtailed because of current previous market conditions may come back online, and we may see increasing amounts of projects being funded. But I wouldn't expect a glut of production coming online because of currently high prices.
Okay, thank you. We have a question here about the Reddit platform and silver price behavior earlier in the year. If we see another development online through social media, whether it be through Reddit or another entity, what impact will that have on the silver price?
Well, if you remember back into Jan and early Feb, silver prices certainly spiked. They just got above $30 briefly. That sort of behavior is possible, but I think, obviously it depends on the wider backdrop as well, because at the moment, investment demand for silver is much stronger than it was when that all kicked off. So perhaps I'm not sure how much more coin and bar demand could actually physically take place. As I said, the US really is at limit at the moment. Lead times have extended. There is not much more, I would suggest, that the trade can do in the US to get more product out. And that isn't just a US, I guess, phenomenon, because other mints around the world that are supplying product in are also stretched. They're doing as much as they can to secure blanks and get the production out really as quickly as they physically can. But as I said, demand is also strong in Germany. So, but of course, there is the potential for renewed buying in the exchange-traded products, as we saw. So, that is one area where you could see that return. So, yes, I think that there is still room, I guess, for that buying or vehicles that could absorb that buying and the potential for prices to do what they did again. But I would be surprised, if they do much more than get it's hard to say, but, I think around that limit is probably where we see prices head again.
Okay, thank you. Here's another question here, and it has to do with recycling. Is there, in your view, do you see an increase in recycling volumes in 2021? And if so, what will the main sources come from?
Sure. Yes. So in our slide deck, if I can find it, we did show here we go. So we are looking for that's not much use, is it? That's better. A rise in recycling of about 14 million ounces for this year, following from last year. And I guess there's a couple of reasons. One, price strength benefiting more the silverware than the jewelry. That's where you tend to see that action. But the other one is on the industrial side, and there's a couple of elements. One, in terms of the EO, the ethylene oxide market, the ongoing changeouts, just because that market year by year is getting bigger as more plants come on stream, or and those plants are getting larger in terms of the amount of silver, and so you just have the natural order of those changeouts. And the other element, Mike, is high gold prices rather than silver, which is making the e-scrap more economic. That was a factor last year that helped the e-scrap side, and we think that will be a factor this year as well.
Okay, thank you. We have time for a few more questions here. With respect to 2020, it saw a big market for non-good delivery AG conversion to good delivery silver. Do you have any views for 2021?
Well, that was, largely tied to the exchange for physical issue and the need to get silver into well, into New York primarily. So do I see that being repeated, that crisis? Well, I think you need that, if you have those circumstances again, then that is a possibility. But given where silver COMEX stocks are now, I would suggest perhaps not, given my understanding is that we've had, some of that silver actually pulled out of New York and shipped back into London. I think the other element is, of course, that you've had, really weak Indian demand. I spoke about the significant investor liquidations last year. Plus, you had a rise in recycling. That wasn't the other element I didn't touch on in the previous question about recycling. And so a chunk of the silver that was sitting in bonded warehouses in India, that was shipped back into London. Now, in fact, shipped back into London, by definition, that's going to be good delivery silver. But if some of that silver was perhaps non-good delivery, of course, that would need to be upgraded as well.
Okay, thank you. Here's another question here. Certain financial institutions are just getting out of the physical precious metals business. How does this change of market liquidity, could it impact buyers, investors, and sellers?
That's a really good question. I mean, that's a fair point. You've certainly had one or two pulling out, and I think that may have been at the margin a factor as well early last year. So I think that's when it really resonated in the marketplace. But at the same time, you have had others, I think, stepping in or stepping up as well and expanding that presence. So net, I couldn't really comment, but I don't think one could simply look at those that exited and say that, because they've exited, that is a palpable hit to liquidity because of the other participants, which are now more prevalent.
Okay. A few more here. With respect to President Biden, at least here in the United States, and his climate action plan, coupled with his infrastructure plan, what impact will that have on silver?
Well, I guess you can look at it from a couple of different aspects. One, and I touched on this in the presentation, that investors are concerned about the inflationary aspect of these plans. And I think that's helping, coin and bar demand, especially in the US. If one looks at it from the industrial point of view, that I think is ultimately positive on a number of aspects, be that in terms of electric vehicles. You think about the reports that we produced for the Silver Institute a short while ago. Silver is already heavily used in, ICE vehicles, but as you move from ICE to hybrid to EVs, net, that's a positive. The solar market is already very strong that we've spoken about. So I think there's a number of different elements, and even just the standard infrastructure, silver uses in contacts and other elements is not, perhaps doesn't get the headlines, but it's an incredibly important area of industrial demand. And when the amount of silver used in these elements is trivial on a unit basis, there's no pressure to thrift. And so, I don't think that should be underestimated how important that is. So I guess you could argue that from a silver market point of view, either in terms of ounces industrial or price action, it's a positive both ways.
Okay. Our last question is for Adam. And what are your expectations, Adam, for mining costs this year?
So I didn't mention it in the presentation, but I go into that, or we go into that in the actual report. But just briefly, we expect costs to actually fall again in 2021, and that will be driven by the recovery from COVID. So there'll be a lack of suspensions at mines if they're able to operate at full capacity throughout the year, then unit costs will be lower. Also, we're expecting higher byproduct credits. So base metal prices, copper, zinc and lead, all rallied in the second half of 2020. and they're currently remaining strong. And also the gold price is still high, so byproduct credits will probably increase. Offsetting this to some degree will be the recovery in the oil price, which will feed through to diesel, and also potentially higher capital expenditure because margins are now higher, so that should enable a higher level of sustaining capital expenditure. So our expectations overall are for a fall in the operating costs of silver mines.
All right, well, thank you. Philip and Adam, again, thank you both for an excellent presentation and report. We've run out of time, and this will now conclude today's webcast. Should you have any questions about today's presentation or on silver in general, please reach out to us via email at info@silverinstitute.org, or you can simply call me directly at 202-495-4030. And on behalf of our member companies and our World Silver Survey sponsors, I'd like to thank you again for joining us today and wish you all well. Thank you very much.